Welcome back to the channel of Truth, Trust and Transparency. Today, I wanted to record a quick video to show you how interest rates will affect your cash flow and your investment property position. Now, for this particular example, I'm going to assume you have a $650,000 purchase. That's your investment property. You've paid a 10% deposit, $65,000. You are then left with a loan of the purchase price minus the deposit, which is $585,000. And for that $650,000 purchase, we are going to make the assumption that that property is renting for a total of $600 per week, which means you are able to bring in $31,200 per year in rent. Now, how I'm calculating the stance of that particular property in returns of cash flow. Well, these are my assumptions here in terms of my yearly holding costs. I'm putting in a letting fee, money for maintenance. I'm putting in a management fee of 6% on the total rental amount. I'm putting in $2,000 for insurance. I'm putting in $2,250 for council rates, some water and sewage usage, and then some advertising, leasing, and lease admin costs in there, totaling $500. So all up in terms of costs on paper, that property is costing me $9,975 plus also the interest I pay back to the bank. So $9,975. If interest rates went down to 1%, imagine. If interest rates went down to 1%, I'd pay back 1% of interest only on this amount, plus the holding costs. It would mean this property is $15,375 per year, positively cash flowed at $295 per week. Now, if interest rates increased up to 2% where they were prior to COVID, it would still mean that the property is positively geared $9,525 and $183 per week. Lo and behold, if interest rates would increase another percent to 3%, the property would still be hanging on for $3,675 a year passive income. So how I do that number, just if you're following along at home, I'm taking the interest rate. Remember, as an investment property, I'm paying interest only. I'm timesing 585 by 3%. That's going to give me the interest that I'm paying per year, which in this case is $17,550. That is the interest I'm paying. My other costs are $9,975, which means my total costs are $27,525. Obviously, I'm collecting more in rent, so it's obviously the difference of that. That's how I get to my $3,675. That's how I get to that fee. Just so you guys know, that's how I'm calculating it. Which means even at 3%, I'm $70 per week cash flow positive. Now, where this property starts moving into negative gearing territory is when interest rates climb above 3.6%. 3.6% is my break-even interest rate in this particular example, where the property starts costing me money. So when interest rates are at 4%, because that amount there now is going to increase, it's going to mean my expenses are more than my rent I'm receiving, and it means I'm in a deficit of $2,175. Now, just quickly, you can now start to see how people got unstuck for COVID if they didn't have the cash buffers available. They might be sitting on 3 or 4 properties, anywhere between 1 and 2%, cleaning up, $600-800 a week, when quite quickly that has come to minus $266 per property. That could be $750 to $1,000 per week out of pocket. So that's how quickly things can change between the interest rate. 5% interest rate, the property then becomes negative $8,000 per year, which means $154 per week. Or like we're at the moment, 6% interest rate, meaning the property is costing me $13,875 to hold for the year, or $266 per week. That's kind of how interest rates can affect your cash flow. And as you can see, it can be a really good story or a really bad story. if you're watching this episode and you're worried about this kind of stuff, this is why it's always important to, when you have equity available in your property, is you can get an equity release, you can sit it in your offset, and you can have a buffer there of that money, or you can build up a safety barrier of anywhere per property, 10 to 15K. Now think about that, for example. If I've got a buffer of 10 to 15K per property, and the property is costing me 266 a week, I've built in 12 months buffer before I need to start to panic. And guess what? In 12 months time, my rents probably went up too. So that's a good example of why a 10 to 15K buffer per property means I'm going to be pretty safe should there be any issues. So that's why 6%, 12, that's for 12 months. So that's what we've had at the moment in terms of high interest rates. So that's a really good example of why you have a buffer. Now, another thing I will let you know, and another calculation is, if rents were to increase to $650 per week, right? I've said it before on videos on my channel, and I'll say it again. Every time, as soon as we buy a property and the rent is at its lowest, because remember, we're buying in good suburbs and the rent is going to start increasing. When the rent is at its lowest, when I first buy, that's when it's most hardest to own. And also when interest rates are 6%, it's a double whammy. But when rent goes up, now this could be 600 to 650, that could be 12 months, that could be 14 months, could be 8 months, it could be 2 years. But when that property does go up, that means that I can then tolerate a 4% interest rate with $650 a week rent. My property is now neutrally geared. Now you see, obviously, the more that rent goes up, the more this line or this safety line will increase and move that way. That gives me a better opportunity of that property being cash flow. The only reason I can get that is if I hold that property long term and those rents start to increase. Whereas if you're panic selling after the first 12 or 18 months, yeah, you might be bleeding a little bit, but just remember, when interest rates come down and we get closer to that magic interest rate, is when you're going to start getting into the neutral or the positively geared territory. So lessons from this video. Number one is, obviously when you first buy and own, that is when it's hardest to hold. Once rent increases and now 6% interest rates get back to something a little bit normal, will that property come into neutrally or positively geared territory. We've also learned the value of having 10 to 15K in an offset against each property. Because of that buffer, it means I can wear these rates for even 12 months before I even need to think about putting more money to it. And we can see just how quickly a portfolio can change from paying you $300 per week, which is really great actually, down to 266 negative, just because of the interest rate moving from 1 to 6%. So I always say interest rates come, they go, they increase, they decrease. It is a fluctuation. Build in the buffers and the mindset to be able to navigate past those. Remember, when you first buy and hold, it's the most difficult, but after that, it starts getting easier as rents increase. Any questions from today's video, let me know. If not, I'll see you tomorrow.